All right, ladies and gentlemen, I hope you had a wonderful day. We had a very calm day today compared to the other day. The Russell had that rotation once again, and then after hours, the earnings out of Google and Tesla, it really killed some things, and even the video was like, I'm going down too, and it was pretty big. I think you actually moved about the same size, if not a little bit more, after hours today than you did all day today. So tomorrow, we got a little bit of data. We still have more earnings. Remember, there was about 29% of the S&P 500 that is reporting this quarter, and then we have PCE at the end of this week, and then next week, before you know it, I think about a week time from now, you will be hearing from Jerome Powell and the Fed. So we got a lot to talk about, but today's watch list, I am going to make it a little quick, and we are going to talk strategy because we had a nice $1,000 in a day off of Tesla. There was a nice earning strategy that got us paid before anything happened today, and it still allowed us upside throughout this whole earnings, and I want to go over that strategy. Some of you know what it is. However, there was something really unique about this trade that I think for the rest of this earnings season, you will be able to apply for every other trade. So I got that. I have the plays, a quick little rundown, and then we're still going to do our economic lesson. What I need from you, a thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/thestackmarket. We will see you there in the morning. And I don't have a top question. We actually kind of had a top debate. So before we get into the lesson, what I'm going to show you is Miss Kamala Harris getting grilled by another fellow Democrat, Tulsi Gabbard, and this was from the past presidential election because on stream today, a lot of people didn't realize that Kamala ran. When we nominated and elected Joe Biden, Kamala was in that race. They made her the vice president, but she was one of the first people to drop out, and nowadays, apparently, people question what she did with jailing people over certain things. So here is a fellow Democrat or former grilling her about that about 4 years ago.
Congresswoman Gabbard, you took issue with Senator Harris confronting Vice President Biden at the last debate. You called it a, quote, false accusation that Joe Biden is a racist. What's your response?
I want to bring the conversation back to the broken criminal justice system that is disproportionately negatively impacting black and brown people all across this country today. Now, Senator Harris says she's proud of her record as a prosecutor and that she'll be a prosecutor president, but I'm deeply concerned about this record. There are too many examples to cite, but she put over 1,500 people in jail for marijuana violations and then laughed about it when she was asked if she ever smoked marijuana. She blocked evidence. She blocked evidence that would have freed an innocent man from death row until the courts forced her to do so. She kept people in prison beyond their sentences to use them as cheap labor for the state of California. And she fought to keep cash
So if she disagrees, you guys could go watch it, but her response, she doesn't deny it. And believe it or not, and this is why it's the question of the day, because everybody was debating in what did Kamala do, and we looked it up. If you have any info, it's kind of hard, but apparently when it comes down to the fact checkers, they don't say this is true nor false, but they say there is no more data against this. And then in this video, she doesn't deny it. She just says other things and that she reformed it. And then here's another one for the young guys.
What else do we know about this population, 18 through 24? They are stupid. That is why we put them in dormitories, and they have a resident assistant. They make really bad decisions.
Now, run it, baby!
Walking to the couch, it's the joints on the legs. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
Ball right off the bat, let's get right into this strategy. And you may have heard it a lot on this channel, but I am going to talk about how to make options free. Now, you may get some of it, but there was something very unique about this trade that I want you to add to your repertoire, because if this comes up again in the future, I really think it is going to be an easy play. So I have everything in writing, but let me just show you on the transaction history very quickly. yesterday, I bought those Tesla puts. We did this live on stream. I told you the strike price and all of that. If you had the stream alerts, you would have got it. I grabbed 50 of these Tesla puts for next week, $195 for 55 cents. This morning, about 15 minutes into the day, I sold 40 of them for 73 cents, which was about 40%. And then you'll see I sold about 5 more puts, and then I bought a call. There was a lot going on here. So what I did was the initial play, then I made it free, then I sold half of the free puts, and then I grabbed a call to turn that into a free call. So if you are unfamiliar, if you have watched this channel, you know exactly what I'm talking about, but I definitely get this a lot. They're like, Josh, what do you mean by making it free? How do you make an option trade free? And well, here are the numbers. I bought those 50 puts for $55 a pop. That was $2,750 for the whole trade. And this morning, I sold 40 of the 50 puts for $73 a pop, making me $2,920. So if you compare that to what we put in, I walked away with $170 net realized profit, meaning I made $170 more than what I put in yesterday. So there's my profit. I closed out of the trade and I got all my money back. But then since I only closed 40 out of 50, I had 10 puts remaining. These are the free options. Now, we talked about this because the debate is that it's still your money. So technically, I made about like $900 in profit because I got this 170, but at the time, these contracts were worth about $700 to $800, and it is all pure profit. Why is it pure profit? Because I've already got all my money back. So if the play does lose, I'm losing out on the profit that I already made. But the idea of why we call it free, because if this play did go to zero, if the earnings was not a good move, then my account wouldn't go down. So no matter what, at the end of this play, once I get my initial investment back, my account will no longer go down. It's not like I will end up with less money than what I started with. That's a win, but you are still giving up profits if the trade goes against you. But the good part and why people do this, even myself, it allows you to reduce risk off the table while still have upside if you think something is going to happen. That way you can make sure you're not being too risky, but then if you feel a certain way, if you think Delta is going to go down, you think Tesla, you think certain things are going to happen, this allows you to manage your risk, get your hand in the cookie jar, have upside, and then not be exposing yourself so much that if it goes against you wrong time, the market effery, it is not going to hurt you. So that's the first part of this trade, but somebody was talking on stream and they came up with a really good idea, and I was like, you know what? I like Tesla. It's moved up 50% on the quarter. It's had all of these crazy moves. I think this is a pretty good idea. So what I ended up doing after I did that first trade, like I said here, I'm remaining with 10 puts. Those were my free contracts. So a little bit later, I was like, you know what? I like this idea. We talked about it, and I decided to sell half of those puts, half of the free puts. I sold 5 out of 10, and I got $380 back because the calls or the puts actually held their value. And then I bought a call for $330. So then that way now I have a play both ways for earnings. We knew Tesla was going to report after the bell. Now I have free puts. I've gotten all my big risk off the table. And then I also have a call. The only way that I would lose on this play is if the stock moved less than what was priced in. And even though the options were pricing in a lot, if the stock did nothing, that's how you get clapped. Even though the stock moved 8%, I think that was priced in. We still might end up losing on this one, believe it or not. Regardless, I still like this play because even though there was a chance of losing, how this is usually different than my other plays, instead of just selling and making it free and taking that risk and doing all that, I was able to turn one free put into a free straddle, playing both ways for earnings on a stock that has moved 60% in the quarter. So that got me super duper hyped. I hope a lot of you guys were able to make money. We documented that play very, very well. But now here is the thing you got to add to your repertoire. This, and then we'll even talk a little bit about what happened today, but this play was very unique, and this is something I really want you to know, because why did I go with such a big amount on that the day before earnings? it is because the stock was up 5%. And lately, there's been a lot of weird earnings moves, and we've been talking a lot of the back and forth. I wasn't even expecting much for this earnings season. Now, I don't know when you're going to watch this video, earnings seasons change, but for this quarter, I wasn't really expecting companies to do too crazy. So if you see a pre-earnings move the day before, and that stock is up more than 5%, my plan, or what I'm saying, not a recommendation, do not trade, but this is why I justified this trade, and it's something I am going to be looking out for. If that thing is up more than 5% the day before, like the night before we do the preview, or the night of, but the day before, just like yesterday, Tesla was up 5%. If you see that going up or down 5%, a big margin, I would buy multiple of the opposite direction, and I would wait until the morning, and then I would make those plays free, and hopefully you could turn it into this trade. But if you're not getting it, the answer here of what you want to look for, pretty much 2 days before the report, the day of, you want to look that day before. If there is an outsized one standard deviation or half of that move ahead of time, that could be your signal to play the contrarian play, get multiple, and then you can maneuver out of it. Because the way I was looking at it, that play I could have lost if Tesla kept going, but even if Tesla went up another 1 or 2%, I figured those options were already crushed since they actually got clapped, and then that way I really thought the upside was a lot bigger than the downside, and sure enough, that actually played out. So I'm going to be looking out for this. You let me know if you find anything, but if I do see another one, I will definitely let you know, and we will document it. But that is all I have for you. The only other thing you got to see today, I made a mistake on the data. I thought the PMIs were yesterday or today. It's going to be tomorrow, and those will actually be big. Otherwise, I would really start punting until PCE. We are going to have a lot of earnings, and that can give us an idea. But so far, tech and the consumer, yeah, you're getting even big moves right now, after hours and all of that stuff. But I wouldn't say it's anything like too worrisome in the sense of earnings are scaring people and shocking them out of the plan. But there's one thing I did notice today, and this is what I was telling you, that Russell rotation is still real. It is still in full effect, and I think moving forward, just keep your eyes out for those dynamics to support the small caps, support this rotation, and if that's the case, this is still the same exact setup from about a week or so. So get ready for the data. We'll see where this all takes us, but now let us get into the plays. So, right off the bat, it's actually super simple today. I only got one play and one play only. This is the only play I made today. I mean, yesterday, I didn't even make that many plays. I was riding out the other trades. So, and like I was telling you just the other week, if you make the plays ahead of time, you're going to be a lot better off. Today, we didn't really move much during the day, but I made money on my gold trade. That went up a couple $100. We made about $1,000 on the Tesla, and then I added to my oil trade at the bottom. And that was, remember, I was waiting for this. I finally added to it today, and then that was able to go up, but the fact of the matter is most of the money came from the day before. But don't let me rant too much. The point is, oil, I finally bought it, but I am kind of concerned. I don't think you should fall in love with this play. I would watch to see if the politics can start hitting it and affecting it with everything we've seen over the last couple of weeks. But here's what you got to know. You have pretty much about a week or so, and oil declines from August through November. We were even talking about it with all this political stuff going on. Oil is very weird. Why? Go look at the oil futures contract, and it is in backwardation, meaning short-term contracts are worth more than longer-term contracts. So if you wanted to buy a contract for oil in a month, it'll cost you a higher price per barrel than a contract a year out from now. That's not too typical. So something's going on there. It's a little bit weird, but it could be some of the seasonality. We even got some oil numbers after the bell, and I do think that political effect is going to be there. So I grabbed that literally at the bottom, like 76.80. I think 20 cents above the bottom today. So I'm going to ride this out for a little bit, but it is going to be a flip. And if it does get ugly, I mean, you don't want to hold too long because seasonality might be able to backfire. So that's all I got. Going to be riding that one out. We will have a couple of earnings plays. I did do a play on Enphase. It was a $20 or $40 play to the downside because I thought they do bad and they will keep doing bad, and the puts were just cheap comparative to what the calls were asking, but I think that one ended up cucking, and then the market just started going crazy here after hours, after Google, Tesla, and everybody else started to slip. So we'll see where it takes us, but I do think the next couple of days should be simple as we get through the middle of the week, a mix of the dynamic of what we've kind of been experiencing this week, a little slowness, and then don't forget everything we learned from last week. But now, Chattadonia, Let's get into our lesson here on multinational corporations. Today, we're going to talk about bargaining. We were talking the other days about advanced industrialized nations, how they manage the politics of the MNCs, how the developing nations deal with it. Everybody wants the FDI. Nobody wants to give up control. How do they come to these conclusions to work out these agreements to allow it to happen? Well, this is what we are about to learn right now. So, bargaining with multinational corporations. Many host countries try to restrict MNC activities, but few can dictate the terms under which MNCs invest. Instead, host countries and MNCs often bargain over the terms under which investments take place. We can think of this bargaining as oriented towards reaching an agreement on how the income generated by an investment will be distributed between the MNC parent and the host country. The precise distribution will be determined by each side's relative bargaining power. So remember, bargaining power and the stuff we learned about the WTO and trade, who has the power, staying power, and all of that. This is all related to it. And then it's just explaining that you can't, if you're a host country, you can't really restrict investment or certain activities all so well, but you can alter the terms. And that's where a lot of the bargaining stuff comes into play. So continuing, bargaining power arises from the extent to which each side exports a monopolistic control over things valued by the other. To what extent does the host country have monopolistic control over things vitally important to the MNC? Does the host country control natural resources that are not available in any other parts of the world? Does the host country control access to a large domestic market? Does the host country control access to factors of production that yield efficiency gains that cannot be achieved in other countries? The more the host country has exclusive control over things of value to the MNC, the more bargaining power it has. Equally critical is the extent to which the MNC exerts monopolistic control over things of value to the host country. Does the MNC control tech that cannot be acquired elsewhere? More broadly, are there other MNCs capable of making and willing to make the contemplated investment? The more the MNC has exclusive control over things the host country values, the more bargaining power the MNC has. Bargaining power, therefore, is a function of monopolistic control. So, where do you get bargaining power? Monopolistic control. Can you control the resources? Do you have access to a big set of people? Do you have all of the money? Do you have a tech that one of these countries want? The more monopolistic power you have, the more bargaining power you have on a country corporation level. It sounds wild to say, right? But continuing, host countries have the greatest bargaining power when they enjoy a monopoly and the MNC does not. In such cases, the host country should capture most of the gains from investment. In contrast, an MNC has its greatest advantage when it enjoys a monopoly and the host country does not. In these cases, the MNC should capture the largest share of the gains from the investment. Bargaining power is approximately equal when both sides have a monopoly. In such cases, each should capture an equal share of the gains from the investment. The gains also should be evenly distributed when neither side has monopoly on things the other values. In these cases, neither side has much bargaining power, and they should divide the gains relatively equally. The distribution of the gains from any investment, therefore, will be determined by the relative bargaining power of the host country and the MNC. We could apply this logic of this kind of bargaining analysis to investments in natural resource industries and in low-skilled, labor-intensive manufacturing industries. In natural resource investments, bargaining power initially favors the MNC. And few countries enjoy a monopoly over natural resources, thus MNCs can choose where to invest. Also, because the MNC often does not have a monopoly over the capital, the techniques and the tech required to extract and refine natural resources, and because the return on investment is initially uncertain, the MNC bears all the risk. The MNC can exploit this power asymmetry to initially capture the larger shares of the gains from the investment. So this may sound confusing. It's going to keep going on, but some of you are probably like, what do you mean you don't have control over natural resources? Like, what about Saudi and what about oil? It's part of it, but like in a weird way, you got to really think about it. The countries you can't really control a natural resource, even though it is all flowing and occurring. Even think the metals in China, but that's initially. That's kind of the whole key. So moving on, over time, however, bargaining power shifts to the host country in a dynamic that has been called the obsolescing bargain. Moran, 1974. The MNC cannot easily remove its fixed investment from the country, so the investment becomes a hostage. In addition, the MNC's monopoly over tech diminishes as the tech is gradually transferred to the host country and indigenous workers are trained. If the investment proves successful, uncertainty about the return on the investment diminishes. Unable to threaten to leave the country without suffering substantial costs, costs and no longer controlling tech needed by the host country, the MNC sees its early bargaining power weaken while the host country's power strengthens. The host country can exploit this power shift to renegotiate the initial agreement and extract a larger share of the gains from the project. Indeed, one might suggest that the widespread nationalizations during the 60s and 70s reflected precisely this shift of bargaining power to host countries. So, one, remember 1960 and 70, this whole idea, the developing nations, and when they're like, man, we just go nationalize and take these things. That's what it's saying here. But if you're not understanding the obsolescing bargain, it's saying initially you can't really place a monopoly over certain resources, and then these companies come in, they bring the tech, they come in and train your labor and all of that, and they find the ways and they spend all that money. And at first, the corporations are raking in hand over fist, but then as time goes on, all of that stuff these corporations do, it's all stuck in another country and it becomes hostage. Let me give you another example. This is an age-old adage in business. If I owe you $1, I have a problem because I owe you money. I don't want to owe anybody money. That's a problem. If I owe you $1 million, you have a problem because you just gave me a substantial amount of money and I'm not giving it back. Yeah, you would think it sucks to owe money, but at least I got a lot of it, and then there you go. That's kind of what happens with the obsolescing bargain. These companies come into these countries, initially they're getting 90-to-1 return, you know what I'm saying? They ain't giving anything back to the host, but then they build these factories, bring in this tech, and then after 5-10 years, the labor knows what they're doing. People learn the process. The tech gets transferred to the country. They learn how to develop it or find advanced ways. And then this whole like nationalization thing, think about it. They're like, man, well, we'll just take it. What are you going to do? If you don't hook us up, we could just shut your factory down right now. So that's the obsolescing bargain. It's kind of crazy, but kind of fascinating and unique. But continuing, MNCs enjoy more bargaining power than host countries in low-skilled, labor-intensive manufacturing investments. On the one hand, no host country enjoys a monopoly on low-skilled labor. Thus, MNCs can pick and choose between potential host countries, nor are such investments very susceptible to obsolescent bargain. Often, investments in low-skilled manufacturing entail a relatively small amount of fixed capital that can be readily moved out of a particular country. In addition, tech in many manufacturing industries changes rapidly and therefore is not easily transferred to the host country. Consequently, unlike natural resource investments, manufacturing investments do not become hostages and host countries do not gain power once the investment has been made. So hopefully you're getting that one too. They're saying in manufacturing, you can't monopolize low-skilled labor. You could go anywhere and teach anything with manufacturing to anybody. And then mobile capital, what does that mean? That means you could build a factory, but then you could take it and move it. And it's not going to cost you a lot. You're not going to have a big sunk cost or any of that stuff. You could quickly move it, and the tech changes so much that even after a couple of years, it's not like it's high technology, necessary, and proprietary. They're like, all right, we'll just get something new and better for probably cheaper. And that's where the obsolescing bargain does not hit the low-skilled manufacturing as much. Continuing, evidence that MNCs enjoy greater bargaining power than do host countries when it comes to manufacturing can be seen in the growing competition between host countries to attract such investment. This competition has emerged in the form of locational incentives. Package host countries offer to MNCs that either increase the return of a particular investment or reduce the cost of that investment. Host countries offer two types of incentives to MNCs. Most offer tax incentives, and one such incentive, MNCs are granted a reduced corporate income tax rate. Many governments also provide tax holidays, usually a period of 5 years during which the firm pays no taxes. MNCs are also exempt from import duties or permitted to depreciate their investments at accelerated rates and are allowed to substantial deductions from their gross incomes. Many advanced industrialized countries also offer MNCs direct financial incentives. In some instances, they are provided as a grant from the government to the MNC and some as a subsidized loan. So it's saying all of these countries in the areas where they don't have a monopoly on something and can attract this forward investment, they start offering these locational incentives. And now here's the thing. I think you got to learn more about this and it'll be good, but I could probably make you another video related to a kind of another topic. But all of these things, this is actually very important for businesses and taxes, but import duties, tax holidays, deductions on gross incomes, and accelerated depreciation. This is stuff corporations, big or small, these are benefits for them. And if you don't know why, well, you should figure out. Maybe that's why I'll make a video. You let me know. But continuing, the willingness of governments to offer locational incentives and the size of the typical package has both increased rapidly during the last 20 years across the entire OECD. 285 incentive programs offering a total of $11 billion were provided to MNCs in 1989. By 1993, the last year for which comprehensive data is available, 362 programs offering incentives totaling $18 billion were provided. Within the United States, the typical package averaged between $50 million and $70 million, but the value of that package has been increasing. Alabama provided Honda with more than $158 million in the 1990s to attract this auto producer's new plant. In 2005, North Carolina provided incentives totaling $240 million to induce Dell, the personal computer manufacturer, to build a facility in the state. The North Carolina package, for example, amounted to slightly more than $161,000 per job. The growing use of locational incentives suggests that host countries are at a disadvantage when bargaining with MNCs over manufacturing investments. In some, few governments have allowed foreign firms to operate without any restrictions, and many have actively managed the terms of their activities, in part by using national regulations and in part by bargaining with MNCs. As we have seen, the typical advanced industrialized country has been less inclined to try to restrict these activities of foreign firms than has the typical developing country. We conclude this section, therefore, by considering a few factors that account for such difference. 3 factors are probably most important. First, developing countries have been more vulnerable to foreign domination than advanced industrialized countries have been. The advanced industrialized countries have larger and more diversified economies than the developing ones. Consequently, a foreign affiliate is more likely to face competition from a domestic firm in an advanced industrialized country than in a developing country. The lack of diversification is compounded by the fact that in the early post-war period, most FDI in the developing world was concentrated in politically sensitive natural resource industries. In contrast, most FDI in the advanced industrialized countries flowed into manufacturing industries. As a result, foreign firms were much more likely to dominate a developing country than an advanced industrialized country, and the advanced industrialized countries have felt less compelled to regulate MNC activity. So if you're not getting it, all of these reasons, it's explaining why some of these developing nations pretty much got taken advantage of, or the fact that they were more vulnerable to getting taken over by, if you were a less advanced economy, you were more vulnerable to getting dominated by multinational corporations and all of this FDI activity. So continuing, there also appears to be a strong correlation between a country's role as a home for MNCs and its policies towards inward FDI. The 2 largest foreign investors during the last 140 years, the United States and the United Kingdom, have also been the most open to inward foreign investment. Japan began to open itself towards inward investment as Japanese firms started to invest heavily in other countries. When countries both host foreign firms and are home based to MNC parents, they are unlikely to adopt policies that reflect purely host country concerns. Attempts by the United States or Great Britain to regulate inward FDI would invite retaliation that would make it harder for their own firms to invest abroad. Because developing countries have historically hosted foreign investment but rarely have been the home bases, their concerns are more narrowly based on host country issues, untempered by the fear of retaliation. So this one is talking about, like, think about it. If you are a developing nation and you are not hosting as well as, being a place where they could set up the parent company and where people want to invest in, if you're doing both of them, you got to manage 2 sides of the coin, and you don't want to upset that, where these developing nations, they had no parent corporations there. They were trying to host everybody, so their whole policy, they only focused on one element, and they don't care about retaliation and how, trying to get competition and bring in money if it would affect certain things or make it less likely that parents would come into their country. They didn't really care about that because they didn't have it. But US, Japan, UK, those are things that we have to kind of focus on and be appealable to both MNCs and a place where people want to set up their parent corporation. So finally, there have been fundamental differences in how governments approach state intervention in the national economy. Although many developing countries pursued ISI strategies that required state intervention, most advanced industrialized countries have been more willing to allow the market to drive economic activity. Different attitudes about the government's role in the national economy translated into different approaches to FDI. Even the exceptions to the non-intervention tendency in the advanced industrialized countries are consistent with this factor. The 2 governments that were most restrictive towards FDI, Japan and France, were also the 2 governments that relied most heavily on industrial policies to promote domestic economic activity. Thus, attempts to regulate MNC activity were most likely in countries where governments played a larger role in the economy. All of these factors suggest that we are unlikely to see an abrupt shift away from the more liberal attitudes towards FDI that have prevailed in developing world since the late 90s, back to a more restrictive practice that characterized much of the post-war period. Developing countries have become more diversified and are now attracting more foreign investment in manufacturing than natural resources. As a consequence, some, though certainly not all, of these countries are less vulnerable to foreign domination today than they were in the mid-20th century. In addition, some developing countries are gradually moving away from only hosting foreign investment to being a home base as well. This trend, although involving only a small number of East Asian and Latin American countries, will gradually make these governments increasingly reluctant to restrict the activities of foreign firms they host. Finally, there's no evidence of an impending shift back towards interventionist strategies as long as developing countries continue to pursue liberal strategies that will continue to make it easier rather than harder for foreign firms to participate in the local economy. So, hopefully you got that last little part there. One, this whole idea of MNCs and its development, I want you to understand, some of you, this is your lifetime. This is all the late 1990s. I know, isn't that wild? Foreign direct investment, FDI, MNCs, and the politics and how this is late 1990s. So prior, remember, like 60s, 70s, there was a lot of nationalization, and that's what kind of started some things, but they weren't operating like this. They were not as liberal when it came down to some of these policies, and even nowadays, we're slowly moving into these changes, and what this is saying, and it's true, I mean, I don't disagree. I hope you realize it. If things keep going this way, if it truly is unlikely, like the book is saying, that we go backwards, and I do agree, maybe it's possible we do, but you got to think about it. You're at the early stages. You're at the very, very early stages of foreign direct investment, and I think it's an early new era of multinational corporations. Maybe in 40, 50 years, we'll have to deal with another wave of, the obsolescing bargain. And, maybe over enough time, some of these countries will rein back in to kind of balance things out. But this is a modern phenomena of FDI and multinational corporations. They've been around for a long time. Don't get that twisted. But again, if you haven't noticed, where has this whole chapter gone to? This is why I love it. I love these because we're talking MNCs. We're going to talk about multinational corporations. We're understanding some of their differences, but hopefully you get it. This conversation we're having with these companies is FDI, foreign direct investment, and it wasn't a factor up until recently, up until the late 1990s of how this started to change and morph things, and people are like, oh yeah, we need this, and pretty much FDI is the new crack for a lot of these countries, and you see it why people are getting into that game. That's kind of what we talked about here. So we got a little bit more, but that is the main lesson, Chad. I love you all. I will see you guys tomorrow on the watch list. Or wait, on the stream? Oh, man, but that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, you got to organize your ground. Complaining and arguing, it's only going to set you behind, baby. So start focusing. Get back on the mission. I love you, Chad. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the AM. And